Good afternoon, ladies and gentlemen. Thank you for joining us on the call today. We are proud to host CRDB, and to invite them and to kick off the call, would like to invite our CEO, Mr. Faiz Arab. Please.
Thank you, Winfrida. Good afternoon, ladies and gentlemen. Welcome to our half-year results for CRDB Bank. I would like to firstly thank the whole CRDB team, along with the Group CEO, Abdul Majid Nsekela, CFO, Mr. Frederick, welcome, and the whole team of CRDB. I think I will hand over to Abdul Majid and his team, if they can take us through this presentation. Thank you.
Thank you very much, and you are most welcome, all of you, and from my trust team as well as our investors, those who have been able to join together with me. I'm here with our Chief Operating Officer, Mr. Bruce Miller, our CFO as well, but we have a team from Treasury and the strategy team together for today's conversations. I can also see the Professor Al-Sameh. Happy to see you, Professor, and thank you for last book launch. So today, the way we have structured our presentation, we have created 6 areas. Of course, give a general overview of the current environment. We'll try to share the group overview in terms of what has changed at the group level, and share quickly on the key fundamental strategy we have implemented that has given us those results you have seen. Of course, our CFO will try to cover quickly on the financial numbers, which I believe most of you you have seen it, and we'll try to allow key questions presenting the presentation, and then we'll give you a way forward of the next step. So if I was to highlight quick in terms of operating environment, generally economies are performing well. There is all dynamics in terms of macroeconomic outlooks looks better in Tanzania. In terms of GDP growth, still projected to be around 5.5 to 6 as expected. What we have seen in terms of the inflation has been stable for quite some times. And as you are aware that the country is rated by both bodies and the Fitch, given the B1, B plus, positive stable, which is also a good rating for the country. I think what you have observed is that the challenge we saw in the last 6 months with the forex side. I can say that today we're stable currently, and we have seen the shillings gain momentum compared with the previous 4 or 5 months ago. In terms of this year, we understand this year's general election, but we don't anticipate to see major challenge in terms of power shift, reality of the processes, and maybe few changes on the ministerial level, but relatively the policy remains the same. But what you have observed on the private sector, there has been a slight decline. Despite the demand is quite significant, but possibly the impact why it has not ever going the same demand, because the liquidity remains key for the main challenges, but the market is a bit stable. On the next slide, what we have prepared, you can project. We are trying to show you the industry level. There has been no change on the industry in terms of the current banks and other institutions, financial which are kind of operating. But key fundamental point to note is the current portfolio quality of the industry, which is around 3.17%. In cost to income, I can say that this is within a rather framework.
Abdul Majid,
Can you hear me?
sorry. Yeah, I think your audio is cracking a bit. Maybe you can move the speaker closer to you.
No,
Thank you.
I think that's ridiculous.
Yeah. Let me adjust it so that can you hear me well?
It's improved, yes. Yes, thank you. Thank you.
Thank you. What I was trying to highlight on this slide is the current industry, and I think there has been no any new entrants or changes from the last call, but rather what we can note from this slide is the current credit portfolio quality of the industry, which stands around 3.17% NPL, and also efficiency ratio is currently around 7.8%. But more important, from the market perspective in terms of deposit, the growth is around 8.5% of the portfolio deposit growth from a market perspective. The total in terms of total assets of the industry, I think you can see it is just 6.1 trillions, slightly a bit of improvement. So to say the industry is still resilient, as I can say. In terms of sector perspective or regulatory perspective, maybe there are two big elements taken note. One is the new implemented regulations from central bank, where they have introduced price cap for digital channels, following the implementation of TIPS as a switch payment for all digital payments. And I can see that majority of banks, based on those tariffs, they have been able to reduce their charges. That is one of the big implemented directives. I think the second is on the regulations, which was the act, which was implemented in 2025 on the withholding tax of about 10%. However, given the profit distributions as per CRDB financial policy, where we are giving about 35% on dividends, we are not much affected with the regulations. And obvious, what we need to keep is to keep monitoring about it. On the other side, I think on the market operates, CRDB is operating in Burundi and DRC. I think the positive development for DRC, there was a new regulation 18, in which was requesting all investors for banks to have at least 4 shareholders. With the CRDB in DRC, we had 3 shareholders, being CRDB, PLC, and all fund FU. With that regulation, that means could have been forced to look for another 4 shareholders. However, of recent, that regulation has been more or less put on hold. There has been a shift and is no longer required. And that means we are not supposed to bring in new shareholders as we speak. For Burundi, I think what we can see in Burundi, the market is stabilizing. Forex still a challenge. Inflation is still on the high side. But there is a positive compared with where we're coming from. And the government is continuing to implement financial policy review together with the World Bank. Now, what I want to highlight, I think we have seen our performance. And from the group perspective, there's no changes basically. The slide is just highlighting the key milestones we have achieved. As you can recall, that we are celebrating our 30 years of presence, and that's the milestone we have achieved over the years. The next slide basically is our current presence and access points. I may not need to give much explanation, but the major point to note is that you can see our address bank is growing exponentially. When we discussed last time, I think it was on 35. Now we're talking about 40. And this is the area we keep focusing. But the obvious, our digital is what drives our business. And the branches, we have not been increasing our branches, is on standstill. In terms of, I would say, our staff remain the same. We believe on gender equality. and we are still managing that. We haven't been able to achieve 50-50, but the ratio of 45 is still reasonable. And I think you can see our capital base with this. So in what has changed at the organization level? We have made some changes on the governance framework at the board level, the group. And I can say that now we are in compliance with central bank regulation in terms of gender equality at the board level. Because there was new board members, about 2 from a set of women's, and then there was additional board member in terms of 1 the men's side. From the leadership perspective, our former chairman retired, Dr. Al-Hai, and the last AGM appointed Professor Nema Mori to be our chairperson of the board. So from governance, that's probably the major change. I think the improvement you can see on the board, we are now in compliance with central bank directive in terms of at least 30% women in the board. What we have done and why we are progressing well, I want to keep informing that this is the 3rd year of our 5-year strategy, which has 3 pillars. 1, our strategic pillar is about defense, grow business, but also future-proof. And we have implemented quite significant strategies in terms of different initiatives to achieve what we projected. And I can confirm that the 3rd year, in terms of what we plan, we are actually within the roadmap of our strategic roadmap. And I think the result will be highlighted in the next slide. On the key milestone, what has made us, in terms of the number you have seen, there's quite a number of initiatives. 1 is about technology, in terms of channel, customer, and products. Speaking on technology, we have been running quite a number of projects. And now I can say majority of projects have been fully implemented, and we have started to see the results of investments. And these are the new switch, agents banking, SIM banking, you name it, and enterprise pass. But what we see, and you will see on the next slide, is accelerations of the digital transactions, where you see a shift of customer behavior of technology. On the channel side, we have implemented our full operational agents banking, and our agents banking have been now enabled to create their own customers through the current technology we have deployed. And you will see a bigger shift of the operations from the branch-based operations to the agents-based and the SIM banking operations. We have also deployed a new technology in terms of merchants, where you're using the RIPA number, tiny QR, instead of deploying many processes, but with a solution which is giving us edge to do even much better. On the customer side, a review of the current offerings and try to innovate new solutions. And we can see that within 6 months, we have been able to onboard 768,000 customers. And this is the new technology that's enabled us to recruit that bigger number of customers. For product offerings, I may touch on the next slide, is innovations, but looking on the mass market and special group. And we will see what we have done to make changes for those innovations. When we speak about technology, just to emphasize more, I think we have currently migrated our e-commerce and the POS there with the government payments to our new ASB. And that has enabled us to, in terms of go-to-market, we can be able to launch products quickly and be able to go to market with the new innovative products. Nevertheless, we have automated our switch with a new switch. That means our current payment infrastructure is the new technology. And you will see how the transactions has exponentially grown, enabling us to do more self-service rather than digital, physical-based transactions. The other key upcoming is what we have just completed our CBS. We are about to launch. The project has been finalized. We are going live in the coming week, and that means we'll be completing our investment in technology side. But more importantly, we are no longer use physical KYC rather than biometric KYC, and that has simplified our onboarding processes and improving our fraud management framework within the bank. If you look on how the digital channel are being adopted, just pick on the two elements, for example, and this also goes together with our plan to manage the challenge resulting from the central bank regulations because of price cap, because that will affect our income revenue. However, what we have done based on the technology and implementations, we see transactions are increasing. For example, SimBank transactions has increased almost 95%, meaning that we are able to complement our lost revenue through increase of volume and usage. Another area of importance is that you can see against banking service operations in terms of usages has increased almost 20%, meaning that the two channels currently they are leading. A very interesting part is on the ATM side. In terms of people going to ATMs, the number is going down because majority are able to get services through their self-service channel. And through our value chain roadmap implementations, there is quite ecosystem payment which we have included our customers. And that's why you can see on the internet banking, the transaction is growing and it has reached almost 18%. On the case of partnership, last time when we were on the call, we spoke about our current integrations with telco, especially on micro lending. If you compare quarter to quarter 2024, we are only able to disperse about 4 million loans to about 4 million customers. But comparing this quarter, we have been able to issue 9 million, almost 9 million loans to customers. Even the volume has increased from 70 billion last year. Now, within the period of 6 months, we were able to issue about 261 billion shillings. And these are the micro lending, more of this. And this is the power partnership we have been looking at. I think the other key channels, which is also contributing significantly, is our current Al-Barak banking. It's one of the growing channels, and especially post-deposit generations. And that addresses our philosophy of financial inclusions. And you can see the growth in terms of last quarter, the 2024 vis-a-vis 2025 year-on-year, the growth is about 58%, and it's keep increasing, growing year-on-year. I think the biggest area the bank is currently focusing, following our formulations of foundations, which is used as an instrument to embrace financial inclusion, but also acquisitions on the special group. The key segment we are looking currently is those which are unbanked, youth and women-led businesses. And these majority are informal. But through our program of banking, through foundations, we have been able to acquire more customers, but to generate more value within this group. And I think you can see from in terms of capacity building, how we've been able to impact the financial knowledge of more than 128,000 were able to be trained. But through this one, overall, we have so far trained more than 2 million customers on the same financial solutions. And for us, we are using this approach through our CRDB foundations because it's easier to reach those unbanked areas, working with local governments to get more customers. Now, in terms of subsidiary highlights, I would say that with our current almost 3 years of operations in DRC, we are current in Lubumbashi, and we have recently opened our door in Kinshasa. And I'm happy to say that in the last quarter, our DRC subsidiary, within a quarter, made a profit, of course, progress in terms of cumulatively. They are still loss making, but it is on declining trend. And we do expect that year end, we might be able to break even this year, if not. I'm happy with our insurance company. Insurance company is doing well. So far, for the last 6 months, they have made profit and still forecast to be making profit even more, because what we have done internally is to maximize the current internal market in terms of CRDB customer base and try to assess who is currently enjoying insurance and how can we be able to give them more insurance services, products within the bank. For Burundi has always been doing well and still doing well. And currently Burundi is number 1 in terms of performance. And we still anticipate to do even much better for this year in Burundi. More important for Burundi is the new coming up project, the SGR, which will be launched on 16th Timisongati, connecting Tanzania and Burundi. It's a bigger project of about $2.5 billion. And CRDB has been able to at least get the entire business of Burundi, which is almost 52% of the entire project here, investment. And that obviously will shape the operation of our Burundi, but also be supported through Tanzania, especially for private sector on the entire value chain. On the climate change, CRDB being the leading institutions on this space, we are doing well. We are currently implementing a program which we have been talking about, the CRDB, and we have already supported many groups of farmers in the Southern Highlands. It's a progressive project. And even now, we are working with our partners to review our current product offerings so that we can be able to offer more service to the group. More importantly, we remember our green bond, which was issued last year, which is registered at some stock exchange. And this year, we also cross-listed to the Luxembourg stock market. And I'm happy that it was well received, and we can see it has attracted many investors, and which we believe that it will signal the readiness of our financial sectors to attract more investors from different markets. In terms of how do we move forward, how do we continue running business, but also creating sustainable deposit? I'm happy that the Kijani bond, we have already, I would say, allocated, being able to utilize the fund almost 83%. We have been able to get all the project qualified, and this is a continuous process. For infrastructure bond, which was launched last year, and I'm happy that as we speak, at least we have been able to onboard majority of local contractors, meaning that they have been able, that gives us multiple benefit. One is about transactions incomes. Second is about generation in terms of deposit sticky. And this is what we have been looking, but also working with selling to do even much better. The upcoming scoop, we just launched our 3rd tranche of scoop bond. This is called the Jara scoop. And the launch was last weekend. We have just started selling the scoop. As we speak, the uptake is quite significant. There is quite an attractive market, and we expect by the date of closure in the coming month, we should be able to oversubscribe the bond. When you look on the sustainability, I think agriculture being the key fundamental sector within Tanzania. In the sector, we are looking more cautiously, but also putting the fundamental right. Through our current CRDB programs, we are working with BBT and many other stakeholders to reach smallholder farmers. And while we are doing so, we are currently as well working with insurance, Tanzania Regulatory Insurance Regulator, TIRA, together with the NAC and other stakeholders to create insurance policy, which will be able to start issuing agriculture insurance as soon. We have also embedded with supply of in terms of equipment, which we have also created asset financing framework as an entire value chain to support the agriculture. And this is our area of focus for this year and year to come. I've already covered CRDB. I may not need to cover that, but I think it's the program which I've been talking. It's now on the operating implementation stage. And this is key in the sense that we are working with cooperative and AMCOs to connect farmers digitally, together with small microcredit lending for those small farmers. And that will enable us to get to even to connect more farmers. The expectation is to have almost 6.1 million farmers, where 1.2 will be direct beneficiaries and 4.9 will be indirect beneficiaries. As I approach to the last, almost to lifetime before I invite CFO, is our governance and whether the growth you see is sustainable. How do we manage our assets? But how do we continue growing our portfolio with an acceptable quality while managing our capital base? Currently, we have activated a syndications arrangement, and we are currently doing select-based approach on the bigger ticket, reading through syndications. Our syndicate is very active. At the same time, through our partnership, we are currently de-risking our portfolio through guaranteed, both from central bank as well as guaranteed from our partner at the lake of FMO, Propaco, and the rest. We are also strengthening our capacity building within the entire network. And this goes together with technology in terms of early warning signal identifications. We believe by implementation of these, but for key strategies, we'll be able to manage our capital better, grow our portfolio with the intention of diversifications. Our key focus is on SME and MSC. The next slide may not need to cover much. These are our group of partners, and we are working with them on 5 elements. And this has been helpful. Why you see that they continue growing is because of our current partners, and which is aligned with our strategy in terms of funding capability, but also in terms of co-creations for lending solutions and also confirmations. And these have supported us also on the trade finance perspective. The next slide basically is what we have engaged with our key partners. I'm happy to say that we have completed our investments in AfriExims. We are currently now among the shareholders, and possibly we might be the first commercial bank in South Africa to invest on AfriExim. We are doing well with African Development Bank, for work together to support our SME review in terms of solutions, product review, as well as operating model, but including the trade finance on the SME side. We have collaborated with Start Hub Africa, especially for financial literacy for the youth, because we believe the future of bank relies on the youth. And this is ongoing programs in a collaboration between CRDB PLC and foundations and our partner. And this is a continuous program. Next slide, just a minute. Trying to move the slide. Yes. I believe you are posting our share performance. I may not need to speak much, but our share price as we speak stands at 1,450, first time ever. And we still believe that our share price will obviously continue to, I would say, continue to increase given the performance of the bank, but also the value of our share. We still believe that they are still undervalued. So for those who are still investing, I believe you can still continue to buy more shares in the bank. Lastly, is about the engagement we believe are key for fundamental. And we believe that having a better resource, the skill set is critical. So within the bank, we have created different programs. First of all, to create our staff to volunteer to support the social actions. And we have started one of the biggest programs currently we're running is a called employee volunteering programs to support the community. Obviously, we as a bank, we believe that the capacity building is key. Leadership to ensure that all the key areas they are well manned with fit for growth, and our staff are empowered to ensure continue innovating services. Lastly, I think we won many awards. The latest one, the biggest one, before we just won the Euromoney Best Bank Tanzania, Best Bank SME, Islamic Banking Best Bank, as well as Sustainable Finance. Many others. This is the result of the outcome of what you have just highlighted. This, what I've just summarized, is what has given us the number you will see in the next slide. And this, I'll ask our CFO to quickly summarize very high level numbers so that we can invite questions to discuss. CFO.
Thank you, MD, and good evening, everyone. Glad to share the half-year numbers. Generally, we recorded a strong performance as we are closing half-year. Profit after tax growth year-on-year, you note 26%, reaching a profit of 346 billion. Again, a record performance in terms of the PAT. But this brings our return on equity at 29.5%. We closed with the MPL, as highlighted in the previous presentation, at 3.0%. And we closed with a cost-to-income ratio of 42.6%. In terms of the balance sheet, strong balance sheet growth. In terms of total asset, we saw the balance sheet total asset growing at 31.7, reaching Tanzanian shillings 19.7 trillion, which is the largest balance sheet in the market. This is mainly backed up with the growth in the loan book, 29.1%, reaching 12.2, again, the largest loan portfolio in the market, supported by the growth in the customer deposit, growing at 36.9%, reaching Tanzanian shillings 13.6 trillion, again, the largest deposit growth in the market, which is almost 2 trillion growth when you look at the absolute number. So in terms of the details of the balance sheet, I highlighted the 31.7 year-on-year growth on total asset. This is mainly backed up by the strong growth in the loan book, which is 29.1%. As you could see, would be interested to understand where do we see the biggest growth. The biggest growth is on SMEs. When you look at the growth in the percentage, 46%. Corporate is growing at 37%, and the consumer lending at 18%. Again, when you look at the funding side, our deposits, as I've highlighted, grew by 36%, reaching 13.5 trillion. And mainly when you look at where do you see this growth, you realize, as we shared in the first quarter, we're talking about the value chain reinforcing, making sure we integrate the payments solution, making sure that we follow the money. The demand deposits grew by 50% on year-on-year, time deposit 41%, but most important, the savings deposit are growing at 26%. Just confirming our strategy is working, and what we shared in Q1 is actually now start to bear the results. In terms of the portfolio mix, we closed our half year with the portfolio mix in terms of corporate retail, 51 in corporate, and the 49, 51 in retail, and the 49 in 51 in corporate and the 49 in retail. Generally, when you look at the diversification in terms of the key economic sector, realize, as we shared in the first quarter, we continue to maintain our loan portfolio in all the key economic sectors, as you saw in the economic highlights. Mainly, you could see our portfolio 36% under consumer lending, agri with 24%, and then the trade at 13%. In terms of the portfolio quality, we continue to maintain a healthy portfolio quality at 3.0% as we are closing half year. But again, in terms of the mix of our NPL over the key economic sector, well aligned at the highest NPL mainly recorded in the agri sector, consumer lending, but this is well aligned with the portfolio exposure and the growth that we have highlighted in this sector. When you look at the coverage ratio, we continue to improve our coverage ratio. As we closed the quarter, our coverage ratio was at 49.9. We still have an exposure on the corporate, which is sitting in the NPL. However, it has strong collateral that's not attracting the provisioning. We continue to engage the customer, and the workout is coming. We believe in the coming quarter we should see this customer moving from the non-performing status. Our cost of risk closed at 1.4, just a slight increase compared to what we had in Q2 last year. Generally, our NPL split in corporate retail, 47% of our NPL is sitting under corporate, and the 53% is sitting under retail. And the split in terms of the portfolio, the IFRS staging is highlighted. The biggest provision or ECL is mainly sitting under stage 1, and that is in line with our portfolio exposure, where you note the growth. Most of the loans are still new, and we don't have the biggest non-performing, though the biggest portfolio. Thus, you could see as we are closing the quarter, 74% of our total ECL is coming from stage 1. In terms of the funding, we continue to command strong deposit growth at a 6.9 year-on-year growth. Mainly the retail commanding the biggest percent in terms of the deposit portfolio, followed by corporate, which is at 38%. In terms of the split in the forex, the local currency and the forex, 76% of our total deposit are in local currency, and only 24% of our total deposit is in forex. The total CASA of our the total CASA for total deposit was sitting at 83%, just an improvement compared to what we had in the previous quarter. In terms of the overall funding, deposits continue to contribute a significant percentage in terms of the funding at 71% of our total funding. The shareholders at 15% and the borrowing at 14% compared to 13%, which we had in the previous quarter. Our LDR recorded a slight improvement compared to what we recorded in the similar quarter last year at 90% compared to 96%, mainly contributed by the growth in the deposit mobilization and the containment that resulted into the containment on the growth of the borrowing. So going on the P&L, as I've highlighted, we recorded a strong performance in terms of the P&L with a PAT growth of 26% on year to year, closing with a profit after tax of 346.5 billion, mainly driven by the strong growth on the net interest income at 21%, driven by the growth in the interest income, which was growing at 25.7% on year to year, in line with the growth in the loan book. Non-funded income again contributed significantly on our bottom line with a growth of 38% on year to year, mainly contributed by the growth on our digital channel and our FX income. Overall, when you look at the net interest income, you realize 78% of our interest income is coming from the interest, is coming from the total 78% of the total income is coming from the net interest income, and the 22% is mainly contributed by the interest expense. You note the graph on the cost of fund, which grew from 3% to 3.2%, just mainly because of what we shared in Q1, the heightening in liquidity, particularly on the local currency, but also contributed by what we see in terms of the increasing collective fund, the reopening of the government bond that has signaled the competition in terms of the deposit, and that's reflecting in the increasing in the funding cost, and that has got an adverse impact in terms of the net interest margin that moved from 8.6 to 8.4. In terms of the non-funded income, 81.4% year-on-year growth was recorded on our forex income. As we shared in Q1, we recorded a strong growth in terms of FX income, mainly coming from our position on our foreign currency, which took advantage of the movement in the exchange rate in the market. In the second half, we continue to record moderate growth. So the 81.4% on year-to-year is coming mainly from the advantage that we recorded in terms of the FX income in Q1. We recorded 29% year-on-year growth on the fees and the commission. And then as you note in the operating expense, the similar growth mainly driven by the volumes. You saw the slide that was highlighting the volumes on the digital channels, 95% growth on SIM banking volumes, the agents banking. The main driver behind the 29.9% year-to-year growth on the non-funded income, particularly mainly contributed by the digital channel, the SIM banking, and the SIM banking and the agents banking. The overall contribution of the non-funded income from the digital channel stands at 38.8%. 54.5%, and the growth on the digital channel on year-to-year stands at 38.8%. So in terms of our cost-to-income ratio, we closed at 42.6% in terms of our cost-to-income ratio, reflecting effective execution of our strategy in terms of improvement of our operating efficiency, and then also backed up by the improved productivity, the growth on the revenue lines. As you could see, we are moving our cost-to-income ratio. When you look at the 3 years back from 50% to date, as we are closing half year at 42.6, slightly above the 41.7 that we had recorded in Q1. We continue to focus on the improvement of our operating efficiency, and we believe we should be able to deliver a better cost-to-income ratio as we close the year. In terms of our subsidiary contribution, we continue to see a positive contribution of our subsidiary, about 4%. Our total contribution from our subsidiary is standing at 5.3%. Our Burundi subsidiary closed with a positive contribution of 20.8 billion net profit after tax, which had a 9% year-on-year growth, slightly below what we saw from the previous quarter and the last year. And we believe in the coming quarters, you would see a better growth from our Burundi subsidiary, given the highlight that you received from the previous presentation. Our DRC Congo continue to post a good progress in terms of its performance, recording again a net loss after tax, which is 3.7 billion in Tanzanian shillings, in US dollar 1.7 million, which again is a decrease of 26% year-to-year when we compare the loss that was recorded last year. But the good news about DRC Congo, apart from the other information that was shared, we saw as we are closing half year, in June, DRC Congo started posting a positive profit in its PAT, meaning that is a strong message towards the break-even as we close the year or as we move forward. Our CIC, our CRDB insurance, again, posted a very strong performance, 356% year-on-year growth, recording a profit after tax of 1.6 billion. Again, you could recall as we were sharing the numbers last year, this subsidiary was able to break even, making a record break even in 1 year. And we believe as we move forward towards the end of year, we could see a very stronger performance from the insurance company. So before I go to the last slide, capital position was maintained above the regulatory capital requirement. Strong capital position, 14.1 in terms of Tier 1, and 14.9 in terms of total capital. You note the slightly decrease in terms of what we recorded in similar quarter last year in terms of the total capital. One is mainly contributed by the asset growth, but again, mainly contributed by amortization of our subordinated capital, which is close to maturity. However, we continue to engage partners to ensure we are able to bring in additional subordinated capital that would beef up our total capital in line with the capital and the business growth requirement. We have fully implemented Basel II, Basel III, which was coming effective from 1st April. And then, as you could see, our capital position in healthy status, and we are confident that we should be able to see the same as we move forward. I would stop here and open for the Q&A, and thank you for listening.
Thank you, CFO. So, we are now, I think we have covered all stages of them, but I think we are ready now to get some reactions on what you have shared.
Thank you so much, CRDB team. Frederick and Abdul Majid, thank you so much for the insight on the half-year results. I think the performance is speaking for itself. For our viewers and the people who have logged on to this call, I think the exciting thing is the share price today of CRDB is at 14.50. Again, congratulations to the CRDB team. The results speak for itself. A couple of things that have been highlighted in this presentation. I think currently the CRDB's Islamic arm, the Al Baraka, has launched its sukuk for both shilling and dollar tranche. On the shilling side, they are looking to raise 30 billion with a green shoe of 10 billion. And on the dollar side, a $5 million and a green shoe of 2 million. And happy to say that we have read that BII is obviously anchoring this issuance, but along with that, ITRUS also has pledged a subscription into this bond issuance. So we will be putting in $6 million in the dollar tranche, and we will be putting 7 billion shillings on the shilling tranche. So I believe CRDB is going to be happy to hear this, and we have discussed this also in their event. I think I will hand over now to Winfrida for some questions that we have. Winnie, we have questions ready?
Yes. So a few of the questions that have come in include, how is CRDB planning to improve its NPL coverage ratio? Further, what was the reason behind the increase in personal lending NPL from 22.8% to 28%? Okay, Karibu.
I just want to, can we get those questions, then we'll be able to respond? We want us to respond with one after another.
Okay, I can read a few more, and then we can address them. Is the bank planning on improving its dividend payout ratio with how the bank is performing? Also, any chance of paying interim dividend? And then, what is the bank's shareholder composition in terms of local and foreign investment in percentage? We also have another one. What is the reason behind the rise of provision from 78%? Would you like to address those first before we get into more questions?
Thank you. CFO, can you cover those on coverage ratio, and I'll cover the other one. CFO.
Thank you, MD. As I highlighted in the presentation, in terms of the portfolio quality, we have our NPL coverage at 49.9%, an improvement from the last quarter where we shared our number. Mainly, meaning we continue to enhance our portfolio quality, but also to increase our provision to cover the loan portfolio in line with the portfolio growth, but the evolutions that we see in terms of the portfolio quality. Most important is the portfolio quality, but also the portfolio mix. The key thing is when you have highly collateralized portfolio, and then if it happens to move to the non-performing status, and then you put it in the IFRS model or ECL model, you realize there would be a mitigation that comes along with the provision that is supposed to come based on the stage where the loan is. So that mitigation, the collateral mitigation, reduces the level of the provisions that you are supposed to, unless you bring in the override that overrides the rules that you have built in the model. The coverage ratio that we are talking about, the 49.9, as explained, is mainly driven by what we talked about. We have a corporate customer sitting on the NPL, which is highly collateralized. Should that customer move out of this portfolio, you would see the coverage ratio coming to 71%. So as I updated, we have continued to engage the customer, and we believe in the coming quarter, you'd see an improvement in the coverage with this customer moving out of the NPL status. As you note, once the customer is the non-performing status, you'd leave him to graduate in line with the central bank requirement. So there is a cooling period also that where you have to leave this customer before you move him back to the performing status. So I think that answers, but our anticipation is to see our coverage ratio at 70% and above. So in terms of the increase, 78% on the consumer, 74%, 28%.
From 22 to 28. The NPL, yes. So NPL per sector.
Okay, per segment. Yes, thank you for that. So this is moved mainly by what you see in the portfolio. The portfolio growth, as I highlighted, the main growth is coming from consumer lending. And the take note, that is one component of the provision. But when you come on the NPL position, you note the agri, which has the highest portfolio, moved down. So when it moves down, you realize the other sector would be affected because you have reduced a significant portfolio that had an NPL, which is agri. So the rest of the other sector will align their percentage in line with what you see. It doesn't imply that there is high non-performing loans on the personal lending, but rather the realignment. Because if you reduce the percentage last quarter, the last quarter, for example, the agri had higher percentage. You could see 36% in this last year, 49%, 28% in terms of the consumer in 2024, and the 22%. And maybe if you could rephrase the question, but I see the portfolio NPL percentage doesn't indicate that there is a worsening in terms of the sector, the segment. It's just 22%. And maybe I would wish if there are any clarification on this question, you may come back.
Yeah. So I think maybe just on the other question you mentioned about with the payment of dividend policy change to the performance. I think it might be too early to say change, given the fact that we have just implemented Basel II, Basel III. At the same time, the bank is expanding its operations with the ambition to grow even other markets. So the current policy, which is at 5%, we believe is still reasonable. However, we continue to monitor and review as we progress in the performance. But for now, it hasn't been tabled as a discussions. And I think given the current regulatory implementations, it might be too early to change the policy for now. I think the other comment you mentioned about the ownership structure in terms of foreign vis-a-vis local. The last current status, the foreign investors, they are currently owning about 18.5, 18.2%. That's the current average ownership. Because there's been increase from 17 to 18. That's what current owning for the CRDB PLC. I hope we have answered the questions, unless you have forgotten one.
So maybe if you could get a clarity, so we could get the clarity on the question on the NPL, or else we see the trend is in line with the portfolio that we.
Yeah.
Okay, a few more questions. The first one, with deposits outpacing loan growth in the quarter, how are you deploying excess liquidity? Question number 2, net loans grew by 29.1%, while NPL slightly improved by 3%. Given aggressive loan book expansion, what is your strategy to maintain or reduce NPL further? The third one, can you please provide us with more details on how you will increase capital through retained earnings and subordinate debt? Let's start off with those.
I will start with the last one. I think on the capital specifically, I think what we have just highlighted, if we look on our current risk-weighted assets in terms of segmentations, we have quite significant portfolio on the trade finance, as well as on the other assets, especially on the corporate side. I've highlighted, first of all, before looking on the revenue or profit, I've spoken about measures we have implemented in place. Majority of our current portfolio, we're doing de-risking, and we are currently implementing the current benefit we have achieved through the partnership on the guarantees to de-risk our portfolio for those which is SME and specific product. At the same time, we have activated our syndication desk to ensure that the portfolio growth is relatively manageable through syndication perspective. And I believe these are the measures which we should be able to address our key capital challenges as for now. Basically, that will be the key fundamental strategies to be implemented as we move forward for this year and next year, before looking at the other options.
Okay, I'll first start with the deposit growth. Where will we deposit growth versus the loan growth? Where will we deploy the excess liquidity? As we share the numbers, You noted we have been conservative in our investment in government securities, and that is where we will deploy our short-term liquidity. But however, again, with the growth in terms of the balance sheet size, we also, you noted, we continue to reduce our borrowing. So the two lines are key lines that explains the improvement in terms of our deposit. But as we move forward, you will see any excess liquidity would be deployed in line with our liquidity management strategy and the plan. And you would see it growth either in government security and the reduction in terms of what we rely on if we have shortage in terms of the funding. That's the actually going for the borrowing. The NPL deduction, number one, as highlighted, our NPL still well below the industry average. We are 3.0%. The industry is at 3.1. As you noted, if it was not the one customer that we are talking about, our NPL position would be far below, and we believe you should soon see the same as we move forward. But we continue to implement our close monitoring, the strategic initiative that we put in place in terms of monitoring, supervision, the enhancement of the origination of the loans, and the management continue to work, and they give confidence in terms of the portfolio quality improvement that we should see moving forward.
I think you can see from the projected slide some of the measures we have deployed to address the issue of how do we continue managing our portfolio quality, but we're able to manage our NPL at the same time, our risk-weighted assets prudently to ensure that we manage our capital better.
Okay, I think you've addressed those three questions. Another one is CRDB's rapid credit expansion and overall banking sector has coincided with rising stock markets and real estate prices. How are you ensuring this growth is financing productive income generating activities rather than inflating asset bubbles? And what safeguards are in place if those prices correct? Can you address that one?
So maybe to get your question right, are you trying to say that our current portfolio growth is aligned with price bubbles of real estates? Are you trying to say that?
I think
want to
that's
get your question right.
yeah. I think the question really is just making a coincidental observation that maybe prices of stocks have gone up and prices of real estate has gone up. At the same time, the banks are doing well and their deposits and loans have gone up. Now, there may be no linkage between the two, but I think this question is coming with that issue that maybe this is linked together. Do you think these are linked or these are just distinct activities happening?
I think the price of stock going up is the result from the performance of the banks, but the key fundamental terms of the bank is how the bank is transforming and how the bank strategically focusing on the key investment of the key opportunities. I would say that the other element in terms of portfolio growth, because we have key sector focus. Our focus key sectors does not necessarily lead to the price up of the other on the real estate basically, because we haven't moved much with the real estate. We have specific sector we are financing on SME space on key productive sectors, agriculture, manufacturing. These are the sector we are financing currently. So I don't think it related, but rather than what I can say that the stock market price increase is the result of the key strategic strategy has been implemented over the period. in how the bank has transformed, but also the future outlook of the bank.
Yeah, I think maybe I'll take on the last question. Just to, first of all, just start off by congratulating CRDB on really fantastic second quarter and first half of the year results. I think the results are extremely clear, what has been shown in terms of performance of the bank, growth in top line, cost management and bottom line has been very strong. Balance sheet growth has also been extremely strong. I think those are all clear. Obviously, capital is something that will need to be looked at. Whenever bank is growing very fast, capital is always a question to be looked at. But I'm sure CRDB team are looking at that closely. My question is the future. Looking forward now, this second half of the year, how will that differ from the first half of the year? And whether we're going to see the strong growth that we've seen in the first half continue in the second half?
Yeah. Basically, I think, of course, it's always to project. I think what I can say, a CRDB perspective, normally tend to do better in second year of the year. So basically, we anticipate to see the same trend of what we have done in half of the year to be our trend toward the year end. Equally, I think I said before that we have just completed our key project, which has also been holding us back in terms of implementing our key initiatives. That will give us key foundations to do even much better. So projected wise, positively, look, there's a positive outlook. Maybe CFO can put some additional comments.
Thank
on
you.
the same, maybe on the last slide, which was pure the last slide projection.
Thank you, MD. Very positive and in line with what we had shared in the first, as we are starting the year, the first quarter, but aligning with what today we are sharing. When you look at what we shared at the beginning of the year and the outlook, we are looking at a growth between 18 and 20% in terms of the loan book. It is 29%, but we are optimistic that we should see this coming back to settle down in the range where we shared. If there is a slight departure, you would see again. You remember this one as we are discussing. We continue to see a settle down in terms of the catch-up growth on the loan portfolio. 2024, we had. You remember we are coming from the 36% year-on-year growth of the loan book. So we believe it should be settling down to where we are seeing 18%, 20%. Deposit, again, we see a very positive with what we closed with as we are ending up here, 36%. We projected to be in 29% year-on-year growth. Again, we believe the outlook remains the same. And from what we see, we believe as we are we'll be closing the Q2, and remember there might be post-election effect, but we don't anticipate any negative impact in terms of the deposit growth. And so as we close the year, we are optimistic that we should see the similar outlook that we shared. The non-performing loans, 3%. We are optimistic that we should see it at 3%. Non-funded income contribution, we are 35.5%. We believe we should be able to see it in the range of 35 to 40%, despite of the development that we have seen in the market with the fees coming on the alternative channel. But the growth of the volumes we see, we believe we should be able to see in the record the contribution and the growth that we shared in the outlook. The cost-to-income ratio, 42.6, we believe still within the range that we shared, and you should see it within or below that range. The return on equity, again, in line with what we shared, and we are confident that we should continue seeing the similar outlook. And the return on equity, it is still within the range that we shared.
Back to you, Prof.
Yeah, back to management.
Thank you. Once again, I'd like to thank the CRDB senior management team for taking out the time. Also, with everyone on this call, thank you so much for being here today. I think in the interest of time, we will have to call it a day today. But I think I trust we are still open. If anyone would like to reach out to us, please feel free. And again, thank you so much, everyone. And thank you, CRDB senior management team. Thank you.
Thank you very much, iTrust, for organizing this call, and we appreciate for our investors who have joined us online. I think you alluded initially about our scope, which is currently being open for investors. Let me use this opportunity to invite those who either missed the launch or they have seen the news to be ready to invest. I think in terms of profit margin, the way it has been structured, multiple currencies is very attractive. So I'll invite those on the call also to become an investor to the scope bond which you have just issued. Once again, thank you very much for arranging this call.
Thank you. Thank you once again, Mr. Abdul Majid. Thank you.
Thank you.